Hello and welcome to this very special edition of Sashakt Niveshak. Joining me today is someone you could call a superman. He's been a banker, he's been a professor, academic of a lot of renown, and now he is the whole-time member at a very dynamic and successful regulator, SEBI. Joining me today is Ananth Narayan. Thank you very much for coming by, Ananth. It's, I think I've seen you in your various avatars, and I was going to ask you what next. Is there something you haven't done?
Thank you so much, Vivek, for those very kind words. I'm going to make sure my wife listens to this podcast straight away. No, it's been an amazing journey. No complaints at all. I've often felt when I was in the banking side and in the market side that stakeholders often speak past each other rather than to each other. So, the market participants, regulators, the government authorities, the industry participants, investors, we all have our points of view and we often stick to our points of view without listening to each other. So I've had this lovely privilege and huge good fortune of being able to sit in the shoes and sit in the chair of multiple stakeholders, whether it's industry, whether it is banking, whether it's markets, and now as a regulator, academia. My attempt has been to try and connect the dots across these various standpoints and various places to see the market from. Let's see. It's a journey which will continue for a longer time.
And I'm asking you this because you spent a few years teaching at one of the finest institutions in India for management. Are you seeing a change in the investor behavior, especially of young people? Because I am referring to the, fantastic research that SEBI came out about, the difference between pre-COVID and what happened during COVID. And I think it still continues to keep getting covered because it was just so phenomenal. The insights out of it, that more and more younger people are coming to the markets, but more and more younger people are trading more than investing. So there is F&O, there is crypto, and of course gaming. So as someone who's, let me say, worked with young minds, what is your sense, especially now that you're sitting in the regulator's chair?
I think you're absolutely right, Vivek. If one was to look at the last 20, 25 years, I think it's been this very quiet, almost a revolution though, aided by digitization, aided by the fact that we've had this massive telecom with everybody now, 118 crore mobile subscribers compared to close to zero in the turn of the century. We've had this Aadhaar revolution which has come through as well, and therefore financial inclusion being digitized. We've had the good fortune and the good planning of having one of the finest payments and settlements ecosystem in the world, and one of the finest securities market ecosystem digitized across the world. DMAT is a concept which, frankly, I think India pioneered in many, many ways. Now, this entire formalization, digitization, telecom boom has, I think, nudged towards people moving their investments and savings towards financial markets. And you're right, there has been a fillip that we've seen post-COVID in this particular phenomenon. I think there were about 2.2 crore unique investors in mutual funds as of March 2020 when COVID hit us. Today, that number is, I think, approaching 5 crores. It's about 4.7 crores or so. Likewise, the number of unique DMAT account holders was about 4.2 crores, give or take, in March 2020. That number would now be closer to 10 crores. It's about 9.6, 9.7 crores. So we've seen this huge tilt towards people recognizing that there is a need to move away from just real estate or fixed deposits or gold into more financial savings. I think this path, this journey of moving away from being just savers into being investors has definitely caught on. In fact, I was looking at the numbers today morning. The last 5 years, in fact, 4 years and a bit, we've seen close to 5 lakh crores of money coming in from essentially through mutual funds, through insurance companies, or through individuals, putting in money into the equity markets, in the secondary markets. The comparable number to the previous 5 years was about 60, 70,000 crores. So we've seen this massive ramp up the last 5 years of money coming into the equity markets as well. Now, there are two parts to the story. There is a huge positive part because, after all, stock markets and securities markets are all about capital formation, right? And you want people to move from being savers to becoming investors. You want these investors to then fuel issuers who come and raise risk capital. That risk capital can then set up industry, can then create jobs, can create more earnings, more wealth, which can then again become a nice virtuous cycle of you create savings, which can become investments. Investments are create capital, create jobs, and it's a nice virtuous cycle. So that's great. And frankly, we have a long way to go even now in this path of financialization of savings. Because while we celebrate close to 10 crore participants in the equities ecosystem, in fact more than 10 crores now across mutual funds and direct holdings, etc., the total number of PAN Aadhaar linked accounts is over 50 crores. Mm-hmm. So we have a long way to go in financial inclusion. So that's a great story. We've started in right earnest. I think the pace has picked up in the last 5-10 years. And that augurs well for India to achieve its massive economic potential. There's, as you also alluded, there's a flip side to it. The flip side is that markets come with risk, and markets come with a degree of uncertainty, which investors should be aware of. What we want is people coming in with their eyes open to the risks, being accepting of those risks, and becoming long-term investors, bringing in long-term capital into the financial markets for capital formation, right? Now, to have deep capital markets, you also need speculators, you also need traders, you also need people who are market makers. Make no mistake, there's nothing wrong with having speculators in the market. There is a problem of degrees, though. If people decide that they want to become billionaires by the time they're 30, and they think that there are avenues to do that in the stock markets or in other securities market, and if they come in with their eyes close to the risks that abound the capital markets ecosystem, which is inevitable, you could see shocks in the ecosystem. So typically what we see is if there is a bunch of people who are coming in not completely cognizant of the risks, and then God forbid something wrong happens, which means that the risks actually fructify and they don't get the returns that they were aspiring to, then the negative shock that creates can actually detract from the trust in the ecosystem and can then cost you several years of capital formation. So which means if too many people have come in and taken on far more risk than they're willing to otherwise accept, and there is a shock, that could create this negative vibe that, oh my God, this is a scary market, stay away from it. And which then could cost you 5-10 years of capital formation. So you need this nice balance where people come in, accept those risks, but you have to ensure that there is ample education about the risks, that people are aware of those risks, so that they are willing and able to take on any volatility which inevitably comes along as a result of being in the capital markets, so that you have sustained capital formation. Now, it's a tricky job for a regulator. Our job is not to be a nanny state and tell people what to do with their hard-earned money. At the same time, it is our investor protection is our number one fundamental mandate amongst the three mandates that we have. And it is our duty to ensure that investor awareness and education is deep enough in this country to sustain capital formation in the long run.
One of the key aspects of managing an investor, Ananth, is a good advisor. And do you believe that the next leg, because when I say next leg, because everything else is done, right? As you rightly said, top class regulatory infrastructure, top class market infrastructure. Unfortunately, for a country of our size, where you need millions of advisors, there are still only a handful, and that too, to remove them from taking commissions. SEBI created a new category, which was the registered investment funds, but unfortunately hasn't really taken off, probably the way even SEBI expected it. We still have too few good advisors available to me, just like you would, for example, go to a doctor, but that's an area where there is phenomenal technologies being used to connect you.
Right.
Is that something that is on your agenda?
Look, it's a journey, Vivek. And you're right. So let's take this in pieces. First off, not as a regulator, but from my previous avatars, my experience is that the average Indian, unfortunately, does not spend as much time and effort on financial planning as she should. Right? It's a bit like personal health. We should be taking care of our diet. We should be taking care of our exercise. We should be doing our regular medical checkups, and we should be having a plan around how we stay healthy for the longest possible time. This is a science. There is a science around how you stay healthy for a long time. It's not necessarily just an art. Very similar as far as financial planning is concerned. After all, the average Indian, an average human being, wants financial well-being. They want to feel comfortable around the state of finances, both for the present as well as for the future, right? Which means that you want to ensure that you can maintain, if not upgrade, your standard of living over a period of time and stay there, right? Now, this requires planning. This requires understanding what your earnings is looking like, what your expenses is looking like, what your assets and savings and investments are looking like, what your liabilities and loans are looking like, understanding the full picture, trying to project it over time, and therefore taking away what you need to do in terms of your expenses and in terms of your investment strategy. Right? This, as I mentioned, is also a science, and it requires expert advice. Right? Not all of us can self-medicate, and we should not.
Yes.
You should be able to go to people for financial advice. So, first off, at an individual level, I think this realization and recognition that just as we go to a lawyer for legal advice, or to a doctor for medical advice, or to an accountant for tax advice, you do need expertise in terms of managing your finances, is a realization I think that we should. Personally, I've had a financial advisor for many, many years now, even though I'm supposed to be a markets person. Now, that's the first part of getting this realization. Adjunct to that, be careful who you associate with, right? Why we need advisor or somebody to tell us what needs to be done. Unfortunately, we also have this plethora of influencers, many of whom do a good job on education, nothing wrong with that. But some of whom are also snake oil salespersons who have perverse incentives and are trying to get you to do things so that they get paid on the background somewhere, right? So one of our big efforts has been, how do we ensure that people deal only with SEBI registered intermediaries, right? Or with SEBI associated intermediaries in some form, rather than with fly-by-night influencers who are simply doing it for their own perverse incentives. Now, to your point about within SEBI registered entities or SEBI affiliated entities, the model which has worked very well, I think, is the mutual fund distributors. Now, they're not directly regulated by us. They are given these ARNs by AMFI, which is the mutual fund body. we kind of regulate them through the mutual funds because as far as we are concerned, mutual fund distributors are extensions of the mutual fund themselves. So if there is something that goes wrong there, we will hold the AMC or the mutual fund to account. That model has worked reasonably well. So we have, I think, about 1.6 lakh ARN holders who are doing a reasonably good job. One of the reasons why mutual fund subscriptions have gone up the way they have, the numbers I gave you, is thanks to this body of mutual fund distributors. Now, the problem with distributors, of course, is that they get paid by the manufacturer, right? So they get a commission from the mutual fund. Similarly, if somebody is selling you a PMS, they're getting paid by the portfolio manager. If somebody is selling you an alternate investment fund, they're getting paid by the fund manager as a distribution fees, right? So there is always this question which comes up as to whether a distributor has your best interest in heart. I'm sure most of them do because they want to deal with you for a long, long time. But there's also this suspicion that there's a perverse incentive that they will try and sell you the product, which makes them the highest commission. The other distribution model, which you alluded to, is the investment advisory model. Right? Now, this works in theory very well because they don't get paid by the manufacturers. They only get paid by the investor, which is you. And therefore, their interests are entirely aligned to yours. So if you tell them this is my wealth and I want you to manage it, they should be looking at your entire overall, earnings, expenses, investments, liabilities. They should be understanding what your risk appetite is, and then they should be designing an asset allocation which is appropriate to your risk appetite, and they should be managing that for a particular fees, which is either a percentage of the wealth that they're managing or a fixed amount. Two problems. First problem is, unfortunately, we as Indians still seem to hesitate.
Don't want to
pay the fees. So we don't realize that we are paying fees for distribution in the form of commission, which is coming from the manufacturer. So as long as that comes up in the net asset value of the mutual fund and we can't see it, we are okay with that. We are blissfully unaware of what's happening in the background. But the moment you have to pay a actual explicit fee to an investment advisor, that seems to become a problem. Now, this is where we come back to the point that when you use a doctor, you have to pay for medical advice. Nobody's going to do it for free. When you use a lawyer, he's going to charge you fees. When you use an accountant, she's going to charge you fees. We've got to get into this mold of being willing to pay investment advisors an explicit fee because their interests are aligned with yours. And that's frankly a good model to have. The second thing from a regulatory perspective, which has been a cause of worry, is we've seen some level of mis-selling by some investment advisors as well, where some of them start running quasi PMS kind of schemes. They start managing the funds on behalf of the investors. But none of this takes away from the broader point you're making, which is, frankly, we have too few investment advisors in relation to mutual fund distributors. We need a lot more of investment advisors in this country. I think we've got to find out a way in which investors are more accepting of advisory, which frankly is aligned to their interests. And we've got to find a way, along with the investment advisors, we as in the regulators, of how we get more comfortable of having a lot more investment advisors in the ecosystem in a manner where we don't see mis-selling or wrong things happening in the ecosystem. But the broader point to make is absolutely right. We're on a journey. I think we will mature over time, and I think the number of investment advisors will go up. We have a long way to go in terms of reaching out to investors. As I said, 10 crores to 50 crores, we have a long way to go. We will evolve. We are a young economy. We will evolve as we go along. But there is a lot to be done, both at an individual investor level in terms of improving the quality of financial planning and spending a lot more of time and effort and expertise to manage investments, as well as the regulatory and industry ecosystem to develop the intermediary ecosystem which can support investors in this particular journey.
There was a time when I used to do a caller-in show on television, and almost every second caller, Anand, would say, And of course, there would be experts to answer their questions. And they would say, I bought this with trading in mind, but now that the stock has fallen, I've become an investor. you know, do you feel somewhere that the realization which needs to be reiterated? I'm not saying things haven't changed since then. Things have changed dramatically. And I think now with technology that you alluded to in the beginning, smarter younger people, somewhere the stock market is probably seen more as a trading way of making money quickly, and which they don't, as SEBI's research showed, 9 out of 10 make losses in it. But never mind that. I'm glad that it's somebody's come out with, and a regulator's come out with that kind of research. But do you think somewhere the problem is not being able to segregate trading from investing and believing the both are the same? I can switch from one to the other.
I think it's a great point, Vivek. Let me try and approach this from different angles. I think we still have a long way to go in terms of understanding the concept of risk in markets. We see stories about fantastic returns made by superhuman investors, which we then look to chase without necessarily understanding and appreciating the risk associated with various trading or investment strategies. And that's a big chunk by itself. It's a struggle we've had as well of how do we get investors to understand better the concept of risk, because we want people to be risk aware, as I mentioned right at the beginning. Now, let me throw some numbers at you on this one, right? The year of 2020, when we had COVID, right? And that we had a lot of volatility in the market as a result of COVID. Actually, if you had 1 crore of investments in Nifty, the beginning of 2020, you would end at about 1.15 crores at the end of December 2020. So you would have made 15% return over that year. It's a decent, good, happy return to have, right? That's part of the story. And this is a part of the story we all understand. You see a lot of dialogue and discourse in social media about returns, 15% returns. The question we don't grapple enough with is how you got there. The journey itself, how tumultuous was it or how smooth was it, right? The reality is we went through quite a lot of ups and downs, practically a roller coaster ride through 2020. Your 1 crore would have come down to about 62 lakhs at the end of March 2020. You would have lost 38% of your capital by that time. And thereafter, in a very volatile manner, it finally went up to 1.15 crores, right? Now, a lot of people will tell you, why worry about this journey? Just close your eyes, look at this 15% return that you've made, and therefore stick to a particular security or a particular basket of securities. I'm not sure that's great advice. A, it's not practical. We are human beings who will look at what's happening to our portfolio periodically. B, it's like, a batting coach telling a batsman that the best way to manage a bouncer is to close your eyes. That's not the way you would deal with a bouncer, right? You've got to watch the ball all the way through. You let it go, but you watch the ball all the way through. So this concept of trying to understand the nature of the journey, how bumpy it was or how smooth it was, is something that I think investors have to internalize. Now, one way in which it's done is by looking at the range. I mentioned to you it was as low as 62 lakhs, it went to as high as 1.15 crores, which is where it ended up with. That's one range, but that's again a very imperfect measure. There is something called a volatility measure, which actually measures the variability of the returns, not the price itself, but of the returns. So if you see an increase of 1% one day, decrease of 3% the next day, increase of 5% the day after, that's a variability in the returns. And that does things to you. You have agony, you have ecstasy, you have boredom, all of that on different days, depending on what the return is, right? Volatility is a great measure of that. Now, for 2020 Nifty, the volatility was about 32% annualized. Okay. Now, a question which only an investor can answer, is that an acceptable volatility? And that entirely depends upon you. Nobody can answer this question for you. Do you have the stomach? I come from a lower middle class background. My father transitioned from poverty to middle class. I've seen bad days. I can't stomach risk. So my risk appetite is nowhere close to what my daughter's risk appetite would be, who's seen far better times, right? So that is my personal choice. How can I couldn't have managed a 38% reduction in my net worth in a 3-month time frame. I won't have been able to manage. But that's a question for each individual to answer. What I would like to see people do is internalize this concept of the volatility a lot more in their investment planning and their financial planning. Okay. By the way, the last 1 year has been magical for markets, right? FY24, I think Nifty made a return of about 30%, 31%. Volatility was hardly 10%. This is a dream come true, right? When you have markets only going up with very, very little, almost predictably going up through the course of the entire year. Here is the other catch. Volatility itself is volatile, right? Just because volatility was 10% in FY24 doesn't mean it will remain the same for FY25 or FY26. You've got to be ready for. We've seen Nifty volatility in the 6-month period of the first half of 2020 was as high as 44%, right? So that's one part. Volatility and understanding volatility is something I think investors need to understand a lot. But your point was about trading. Now, here is the other thing which any academic will tell you and any market practitioner will tell you. The more you trade in markets, the less you make. There is ample research which kind of reiterates this principle all the while. And the reason for that is simple. It's like when you go into a casino, the house always wins. And that's because a certain portion has to be paid to the house for the house to sustain, right? So whatever is the money which is being wagered, a part of it will be taken by the house, which means the net earnings is always going to be less than what people lose. Now, I'm not saying our markets are a casino, but reality is there are transaction charges. There is brokerage, there is STT and tax, there is exchange fees, there is SEBI fees. There's a whole bunch of charges which come along with every market institution, which means that you're going to be at least leaking out that percent, that cost. And the house in this case is this market ecosystem, which is providing you this ability to trade and invest, right? So whether it is F&O, intraday trading, we find that maxim is absolutely true. In the case of F&O, as you rightly pointed out, our research showed that 89% of individuals lose money in F&O trading. This was at 23 research. We're going to update the numbers and put it out pretty soon. Intraday trading. Those who undertake intraday trading in shares, preliminary research shows that 70+% of the people lose money. 70% plus, right? And again, a lot of the reason it's not 50%, which should be the toss of a coin, it should be 50 plus, 50 minus, is again because of transaction charges. You are going to leak out those transaction charges. So here is what you have to understand. As a concept and as an individual, if you're not a market maker, you're a price taker. You're somebody who's actually taking prices and trying to hit the market. The more you trade, the less you make, right? That's the first maxim which people have to understand. The second thing that people have to understand in financial planning is, and there's this lovely study which was, I think, in the late 80s or early 90s, Brinson Bauer and Biebauer, I think, Brinson, Wood and Biebauer, which showed that a bulk of the variation of returns across different asset management portfolios can simply be explained by asset allocation. More than 90% of the variation across different portfolios is explained by asset allocation. Only about 5 to 6% can be explained, if at all, by timing the market, by choice of securities, by doing active management of various kinds. Which means all the noise we hear about, this is a great stock to buy vis-a-vis the other stock, or this is a great time to sell, buy it tomorrow, frankly, is a toss of a coin. What matters is you choose your portfolio, which includes equities, which includes debt, which includes commodities, which includes currencies, which includes real estate, all this put together. Once you've decided asset allocation, let it be as it is. Let a good advisor tell you what to do with the asset allocation over a period of time. Don't touch the market too much. that's your best chance of getting a nice, healthy return. Now, you might want risk. You might be a person who actually likes going on roller coasters, right? That's absolutely fine, but do so with your eyes open. F&O, by the nature of its leverage, the fact that there is implicit leverage in futures and options, magnifies the volatility. So for the same amount of capital, if I could take X amount of position in the cash markets, I could take 5X in futures for an average futures, or many times more that in options, right? So you're not only magnifying your possible losses and gains, you're also magnifying the volatility that is associated with it. The moment you go into F&O, you have to be ready for two things. One is you have to spend a lot more time and effort watching the markets and seeing what's happening, because it's going to be very volatile. And second, you have to be ready for a lot more of volatility. And again, be aware that the house is always going to win. The markets are loaded against you, which means more often than not, people will lose money than make money. With all this, people still go to casinos. Knowing all of this, they go to casinos. So if you want to go there, absolutely fine. But be aware of the risks, is all we are saying.
In fact, what fascinated me, Ananth, about that research was that 9 out of 10 did not make money, but even those who did, the average was 1.25 lakh rupees, if I'm not mistaken. I mean, is it really worth it to put that kind of time, effort, energy, day after day, and make that kind of money? That's what make you rich in today's India, 1.25 lakh if you've earned that at the end of the year.
To give you a little more of color on this F&O problem, right? You're aware that a lot of the trading actually happens on the last 1 hour on the expiry date.
Yeah.
Right. Why is that the case? Because that's the time when the premium comes down to almost nothing. Right. It's just a small time value of 1 hour when you're trading at 2:30 in the afternoon on expiry date. Right. So your leverage element goes up dramatically. So that practically becomes a lottery. By the way, what we have found is that not only does much of the trading happen in that last half an hour and last 1 hour on the expiry date, the average investor holds the position barely for 30 minutes, right? So they just get in and get out. Okay, that's essentially a lottery. What you're doing is you're paying 25 rupees with the hope that 25 rupees will become 50 rupees or 75 rupees in the next 1 hour. Okay, it's actually a lottery. Now you can ask the question. Everybody knows that in a lottery, it's the lottery provider who's going to make money, which means that more people are going to lose than the one person who gains, right? So the amount collectively lost by those who lose is going to be far higher than what is gained by those who gain, because after all, the lottery provider has to make money. Essentially, this has become in the nature of a lottery. The last 1 hour of trading in F&O, where you're effectively putting in very tiny amounts, 25 rupees, 50 rupees, 100 rupees, 1,000 rupees, and hoping to multiply that by 3 or 4 times in that short period of time, right? Because you're losing small amounts of money, like in a lottery. Why do people go to a lottery again and again and again in different parts of the country? It's exactly the same phenomenon. You know that your chances of getting are pretty low, but you're just hoping and praying that you hit it big on one particular day. Now, that worries us. It worries us because, look, fundamentally, we are for derivatives. Fundamentally, we are for speculation. And it's a bold statement to make. I'm making the statement. The reason being, you need derivatives and you need traders, market makers, people who can take positions to create depth in the market and to have good price discovery mechanisms. They're absolutely essential to a well-functioning capital market. So speculation isn't bad by itself. But this kind of speculation, this last half an hour of trading on the day of the expiry, becomes a lottery, and it's very difficult to see what the benefit of that lottery is as far as capital formation and price discovery is concerned. You know, people tell us don't throw the baby out with the bathwater if you're taking steps against F&O. In that last half an hour or 1 hour, it's very difficult to see a baby at all in that bathwater. There is only dirt. So that's something that's bothering us. The research that we did in 2023 was an attempt to educate people about the risks, because the stand that we've always preferred taking is we are not a nanny state. It's good to have people engaged in capital markets, but they should be aware of what the risks are. But with the egregious element of this casino lottery continuing to grow despite that, we are now constrained to think about what more we need to do for investor protection and for long-term capital formation.
One final question, Anand, before I let you go. I mean, our parents' generation had, there was no SEBI. Stock market was there, but there was no SEBI. They had different challenges. Our generation, again, probably was somewhere in the place where the regulator just started. There were a couple, scams. We were struggling to do better than our generation. We were not that well informed. And today's generation is probably has inherited a world-class market, a world-class regulator. Do you believe that somewhere we've reached the tipping point where the mass of Indians, and I'm not just talking promoters, we're ordinary people, because if you see last 30 odd years, we now have experience of 30 years of performance of even a few mutual funds, which have across houses, 21%, 22% compounded returns, which is better than Warren Buffett, who we celebrate. Do you believe that we are somewhere at that tipping point where someone sitting in a small place of India, if they follow what you said over the last half an hour, would actually build serious wealth and change their destiny through the equity market?
Let me try and answer it this way, Vivek. I have no doubt that we have the potential. I think we all agree with this violently, that our economic potential is immense. We are a young economy. Our median age population is still 29, thereabouts. I've worked in 12 countries, Vivek, including countries like Vietnam, which you could argue is a young country as well and growing pretty rapidly. I have not seen a single country with the kind of fire in the belly amongst the people and a capability amongst the people that we have in India. I have not come across a country. So purely in terms of potential for the next 10, 20, 30 years for economic growth, I have no doubt about our tremendous potential. I think everybody will agree on this. What we discussed earlier, to achieve our immense economic potential, I also have no doubt that capital formation is going to play a crucial role. Now, in the past, we've relied on foreign capital, FDI, foreign portfolio investors. Now we are awakening to the possibility of domestic capital as well, because suddenly the mass of Indian savers are beginning to see capital markets as a viable and good avenue for them to deploy their savings, become investors, which can lead to that virtuous cycle that we talked about earlier, that people put money into risk-seeking kind of schemes, which in turn bring in issuers who create capital, who create jobs, who create wealth, who then it becomes a nice virtuous cycle. I think we're already in the midst of that cycle. What we are seeing over the last 5-10 years, in fact, over the last 20 years, I would argue, this telecom, this payments and settlements boom, this Jan Dhan Yojana, followed by formalization, followed by financialization of savings. I think it's all pointing in that direction. I think what we have to recognize is the risks that come along with it. First risk, it's important that capital issuers match the investors as well. The last year I mentioned to you, FY24, one of the reasons why we had this magical 31% return on Nifty with just 10% volatility is we net saw something like 2 lakh crores of money being poured in by savers becoming investors, which was higher than the amount of issuance done by issuers. People raising equity was much less than the amount of money coming in through secondary markets. Now, when you have this kind of a huge flow which comes in, that automatically lifts prices. So we can have a lot of explanations as to P ratios, valuations, etc., etc. End of the day, it's demand supply. If there is a lot more of demand for paper than supply of paper, prices will go up. What we need is issuance of paper as well now to match with this increased demand. Because for two reasons. One is you don't want prices to go up purely on the basis of demand without any supply. The whole point of capital formation is there should be supply of paper as well. And second, without that supply, that capital formation will never happen anyway. So you need that. So we are waiting for, I think we're seeing signs of it, but we need that investment cycle to start from industry, where they start raising money to match with this appetite of savers becoming investors. So that capital formation on a sustained basis ensues without this boom and bust kind of a cycle going through. Right? So that's one big part of the equation where we should see issuance coming through as well. The second is this whole discussion we had about risk education and risk awareness and risk acceptance. Euphoria about markets should stop. But there is no doubt that if you're doing things in a planned manner with adequate expertise of trusted people, then the best way to ensure financial well-being and ensure that you meet your nirvana state of being financially happy today and for the future is by having some portion of your savings portfolio in the capital markets. The best way to the asset allocation depends upon your risk appetite, individual risk appetite, but there's no doubt that a certain portion of that asset allocation has to be towards capital markets for you to beat inflation, for you to ensure that your wealth is working for you rather than you working for your wealth. So, in summary, I think we're in a good place. Touch wood. I think this formalization and this financialization of savings will continue. There's no reason it should not. I think it can lead to a virtuous cycle where capital formation ensues and creates more wealth and the cycle continues. But we have to be extremely consciously aware of the risks, both in terms of risk awareness and education, and in terms of ensuring that there is adequate supply of paper as well, so that capital is created rather than just price inflation going through the market. So, last word, the point about volatility of capital markets is there is volatility, and we can't second guess volatility. If it was low last year, doesn't mean it's going to be low the next year as well. So, come in with a long-term investment horizon. Start saving at an early age, becoming investors at an early age when you're still saving. Put money into the capital markets with acceptance of risk, understand your risk appetite and put money accordingly. Stay as long-term investors. No reason why you will not benefit from this. Create wealth and create capital and economic growth as well. One last blurb which my team has asked me to mention. Investor education remains a crucial part of this journey. And like I mentioned earlier, one of the challenges for investors is sifting between the people they can rely on and keeping the chaff away in terms of the influencers who are saying ludicrous things just so that their perverse incentives are met. We've created this investor website in SEBI. It's a website where we've tried to put together basic information about what is there in our equity markets, what's there in our various security markets, how do you do financial planning. Coming from a regulator, we have zero agenda other than financial education. So it's a good place to start with to
start your learning journey.
Starting your learning journey. I have a request for you personally, Vivek. You're in the job of enhancing investor awareness and education as well. Do look at that website because it is, after all, something that has been created by a regulator, not by a market participant. I'm sure there are plenty of feedback that we can and should take to improve that, and it's going to be a dynamic process. We will try and do our bit in terms of spreading this investor awareness across the ecosystem. But it's too far important a role just to be left to the regulator. We need a lot of good people, including people like you, to spread the good word along. I think the future is bright, but we have to be very, very cognizant and conscious about the risks and do everything we can to mitigate them.
My best wishes always with you, Ananth. I wish you a lot of good health, and the country needs people like you.